All right, we'll go ahead and get started. Good afternoon. My name is Doug DiVirgilio. I am I'm on the education committee at Minnesota SCORE, and I'm also a SCORE mentor. And welcome to our webinar on financial literacy presented by Frank Maggio. And before Frank presents, let me just go through some information for you about SCORE. So SCORE is a nationwide organization, not for profit. Everything we do is no charge to you. So that's something to keep in mind. We are affiliated with the Small Business Administration. There are 300 chapters and 10,000 volunteer mentors nationally. And here in Minnesota, which is Sarasota, Manatee County, not including Northport, which is served by our Port Charlotte chapter, we have 90. And I can tell you, it's a very diverse, broad background of business. People have done just about anything you might need. And I would encourage you to consider asking for and putting a request in for a mentor if you don't have one. Our chapter has been awarded many designations over the years, and most recently we were District Chapter of the Year. Now, how can we help you? Well, there are many ways. If you're dreaming about that business you always wanted to start, we can help you with that, with research and planning. There's not just our mentors, but there's a website I'll get to in a minute, which has tremendous resources for you, templates, podcasts, upcoming webinars, recorded webinars. So we can help you in pre-startup, startup, opening can be a big challenge, all facets of that, growth in business. Seen a lot of businesses challenge and derail based on not being able to manage very high success. We can help you with that. Buying or selling a business, exiting, and many, many other ways we can be of service. We sometimes meet with clients once or twice. Other times it goes on for a period of years, depending on the needs of the client. We're here to help you achieve your business success. Now, this is the website I was mentioning. It's score.org/Minnesota. You can request a mentor there. You can see upcoming webinars like this, access recorded webinars, and many, many other resources, including the profiles of our mentors. Now, we had to conclude by thanking our sponsors, without whom we wouldn't be able to do all we do for you. You can see the list. BayFirst is on that. Frank is with BayFirst, so he'll talk a little bit about that. And before I turn it to him, I just introduce him. Frank Maggio is a seasoned finance professional with over 20 years of banking and lending experience. He's got a wide range of commercial loan and deposit services available to him and a broad background. Question and answer, if you have them. Frank would like to entertain them as he's presenting. You can type them into the Q&A box, and I'll be looking for them, and we'll call them out and kind of pause him as he's going, and that's how we'll do the Q&A, and also we'll have that at the end. I do want to mention to everyone that you will receive, after this is done, the PowerPoint Frank's presenting and also a recorded webinar, so that will come directly to you. All right, with that, let me turn it over to Frank.
Sure. Thanks, Doug. All right, let me queue up. There it is. Share. Okay. And I want to make sure I can see the chat as well. There we go. All right, Doug, you can see the presentation, right?
Yes.
Good. Okay. All right. Gotcha. So good afternoon, afternoon. Good afternoon, everybody. My name is Frank Maggio in New York. Great. Glad to see people are joining us from all around. So my name is Frank Maggio. I work at BayFirst Financial. We're a full-service financial institution, a bank, which is based out of downtown St. Petersburg. For those of you that are aware, it's near Raymond James. It's near Tropicana Field, which is where the Tampa Bay Rays play. It's a couple of blocks east of where that is. Locations, though, which I'll talk about in the slides, but we're pretty much in Hillsborough, Pinellas, Manatee, and Sarasota County, so north and south of the Skyway Bridge. I am a commercial loan officer. I'll get into a little bit of that during the presentation, but essentially, I work with businesses, individuals, investors for owner-occupied investment, not just real estate, but businesses, acquisition. The bank itself deals with SBA, Small Business Administration, and the like. We also do consumer lending as well, residential. Again, I'll get into that in the further slides, but just a couple quick Key West, great. I'm from Naples, Florida originally, for those of you that know Florida. And I've been here in Sarasota since 2001. I'm actually a graduate of Florida State University. Sorry for any of those that may offend. But I went to Florida State and I graduated and moved down to Sarasota in 2001 and got into banking shortly thereafter. In fact, I was just mentioning this to Doug before the call. If those of you that might have heard it, my first day in banking actually was the Thursday before that Tuesday in September of 2001. That's how I'll never forget that. Pretty much been in the commercial side doing underwriting and also commercial lending. And just a quick housekeeping item. I apologize in advance. My computer, so I'm in my office in downtown Sarasota. I've got a standing desk set up and both of my monitors are up here and the computer that has the camera is down here. So I'm not ignoring you and I can see two different screens, but I've got the presentation and other screens going on to help with this. So I apologize in advance if that's distracting anybody. So I'll just kind of jump right into the presentation. All right, let me see, got this so I can tab down, good. So introduce myself, these are the sponsors. Oops, I'm going up. These are the sponsors. So I mentioned BayFirst. The bank has been around since 1999. We do have locations, as I mentioned, north and the south of the Skyway Bridge. We are a community banking institution and we do process all lines of business, which most traditional banks do, from commercial, which is your business side, investing, that type, residential as well, and consumer, so like home equity lines of credit, auto loans, but residential, so personal residences, primary residence, and also SBA lending, which is technically commercial as well, but that's government secured lending. Last year, I'm not going to read through all this. You all have this presentation or have access to it, but last year was a great year for us. We've been around since '99, but really over the last, I'd say 12 years or so, the bank under Tony Leo, who's our CEO's leadership, has really grown tremendously, particularly on the back of our SBA division. And then about 5 years or so ago, myself and the market president here in Sarasota, Tom Qualley, were brought in to really beef up the branch, or what's called the traditional community retail banking center division of our bank, and as a commercial lender, kind of helping with that community banking side, which is still lending to businesses such as the ones that you own. But the bank itself, these are all some of the highlight points. We're carbon neutral, one of the best places to work. Probably the bigger thing on this slide that I wanted to point out is that after 100 years, and for those of you that know Sarasota, this is going to mean something. After 100 years of founding the area in Newtown, we've opened up a banking center branch in what's called the Newtown community in Sarasota. It's kind of just north of downtown Sarasota, and it is primarily a minority area, particularly African American, but it is a minority area. There's never been a branch in that area, so that's particularly proud of that. And kind of through that, we've launched a minority lending initiative to where we've lent over $100 million. And we started that initiative last year. We had originally set our goal, I think at 50,000, it was, actually it might've been 25, but we had blown that out of the water and have since lent over $100 million to minority lending, not just in Newtown, but specifically minority lending. The other bigger point on that slide is the rebranding of BayFirst, or rebranding to BayFirst. The bank used to be called First Home Bank. Originally started out of Seminole, Florida, which is in Pinellas County, but then we moved into the downtown market and then rebranded last year to BayFirst. We did not get sold or did not get bought by anybody. We just rebranded and went public, and we are traded on the NASDAQ now as BayFirst Financial. It's BAFN, or the stock symbol on the NASDAQ. Really the biggest thing Doug and I were talking about just before we jumped on this call or went live was kind of community banking in its essence, which is really meeting with customers wherever they are. You know, banking has obviously changed with the implementation of the internet and cell phones and these types of things, but I think you'll find that community banks, true community banks like ours, again, even though we're national and we're publicly traded, but true community banks very much are, you know, sit down, talk with, have a conversation, get some advice, you know, have a facilitated conversation to really help you as a business and as a customer attain whatever it is you need. I don't, as a banker, expect that a business really fully understands everything about finance. And as a banker, I don't always fully expect that I'm going to understand everything about your business. So it's a lot about learning about each other and how, you know, I as a banker can help you succeed as a business. And because not every business owner understands everything about banking and how we lend money and what the qualifications are and things like that, this becomes very much a facilitated conversation. Again, Bay First, it's kind of our tagline here for what's next. It basically just says that as a banker, I'm not just interested in, and as a banker here, I'm just not interested in what I'm helping you with now, purchase of real estate, a piece of equipment, starting your business, whatever it is. I'm interested also in what's the next thing. So I'm always learning backstory and, what are your goals and things like that. But that slide just kind of indicates that we obviously are a full service financial institution. We can help pretty much in anything. Personal solutions, pretty much all the bells and whistles that every bank has. I'm not going to go through everything. Banking nowadays is pretty much cookie cutter in the sense that we all pretty much do the same things. In most cases with most banks, it pretty much just comes down to the people that you're dealing with, myself or any of the branch people, back office people, things like that. It's the personalities and it's who you trust. And that's really what banking, in my opinion, kind of boils down to is a trust factor. It's talking with individuals, making sure that they have your best interests and that they're advising you in what you feel is the best and most fair way possible, and being upfront and transparent. And that's what I personally have always tried to do. So personal solutions, checking, savings, all that kind of stuff. We do have investments. We have an investment advisor, although we do not fully do investments ourselves as a bank. Our investment advisor is an LPL advisor. Some bigger banks like Bank of America have their own plant. Bank of America, I think, is Merrill Lynch. A few others have their own. Investments, full service there. Business solutions, pretty much everything that you're going to find. Online stuff, treasury management to help you, manage your day-to-day activity, your funds, things like that. And then business lending, as I mentioned, that's really where that is my bailiwick. That's my expertise, is the business lending side. Half of my career was spent on the underwriting side. So the people that I send my information to when I want to get a loan approved, I did that for half of my career. And then for the rest of half of my career, I'm doing what I'm doing now, which is the lending, the sales, what's called sales side, production. Business solutions, we work with property owners, tenants, things like that. So the whole point of this conversation is about financial literacy, kind of financial fluidity, as we're kind of calling this. And let me stop here real quick just to say, I put it in the chat, but I just want to kind of audibly say it as well to everybody. As I'm going through this presentation, I've got the chat up so I can see it. So Pablo, I see you said hello, made it, glad you could join us. I can see the chat. I'm not always going to look at it, but if you do happen to put a question in there, please feel free to during the conversation. I really would like this less to be about me just talking ad nauseum, and to be more about some questions coming out so that we can address these things. And Doug will also be paying attention to the chat as well, or the Q&A. So if you have anything, please feel free to ask. And Doug, I've told him before, feel free to interrupt me if I don't happen to see it, so that I can go ahead and address it, because I really would like this to be a conversation and not just to be me talking about what's on these slides. I'd like people to ask some questions and have a little bit of interaction if it's possible. So jumping immediately into financial literacy, probably the most important thing that I learned when I became a banker, and really when I was at FSU, learning finance. And this is actually, technically, it's not something, I'll just give you some information or backstory. This is not knowledge. This is not something that's actually taught in school. This is where the old adage about, learning on the fly or learning things real time as opposed to, street smarts versus book smarts. This is a perfect example. What we call the 5 C's of credit in banking was not taught in finance at school. It just isn't something that's really readily taught. It's something that you really learn when you're in banking and you're doing credit and underwriting and also lending. But the 5 C's of credit is, I think, important for business owners such as yourselves or business individuals to really understand, because at the end of the day, this is exactly what we as bankers are looking at. And we kind of have this in the back of our mind as we're looking at financing an individual or businesses or anybody. And I'm going to go through each of these things, kind of one by one, but just to highlight them: conditions, capacity, capital, collateral, character. And I'll go through the importance of each of these things. And real quick, I see a comment. How do we get in contact? So at the end of this, the information on how to contact me will be there. My email address, my phone number, the website of the bank, and all that. And I think it's included in the package as well too. Doug, real quick, just to ask you the question: the attendees of this, they will get the presentation sent to them afterwards.
Yes, and also the recorded webinar.
Perfect. So
A
my
link to it.
contact information will all be made available in that when you receive it. I will take a quick note too, just to say to everybody on the call, and so that it's at least in the recorded version as well too. After this week, I will be on vacation for 2 weeks, so I do not mind if you send me an email. Just don't expect that I'm going to respond back immediately. I'm going to have my phone with me, but I'm not going to respond to anything while I'm on vacation. I'm actually flying to Brazil with my wife. So we're going to be out of touch and on vacation mode, but please feel free to email me, or after I get back on June 12th, if you have a question and you'd like to call me directly, my office line is included in the information. I'd be happy to answer any questions, not just about this, but about your business or anything else. 5 C's of credit. So character, I'm going to start there. As it says, probably the most important C, and as it says, financial history of the borrower, and it's underscore with the credit score is what this says. And that's kind of really, that's a great question, Pablo. And I'm glad you said that. I mentioned, 23 years. I mentioned that I started in banking in 2001. My first day was actually the Thursday before that, Tuesday in September of 01. And pretty much half of my career has been spent on the underwriting side, and the rest of it on the what we call production or lending side. So I've actually got what I'm speaking to today really scratches both of my sides that I've worked with in banking, both the underwriting side, approving small businesses and businesses in general or individuals, but also doing the production side now. So character. What this says is kind of really only half the story, and I want to kind of bring that up. The credit score is really only one thing, one piece of the puzzle that really goes into character. And the reason why I talk about that, or the reason why I say that is that really character, in my opinion, is really formed on the individual or the business themselves as well. So that, going back to my comment earlier about sitting down and talking with individuals and business owners and learning their story. How are they doing what they're doing? Why are they doing it? What's their passion? What's their future? You know, what do they look? What are their goals? A lot of that's character. You know, it's forming an opinion, which is it's very much subjective, not objective. It's something to where you're learning about the individual in the business. You know, how are you doing what you're doing? You know, why are you doing what you're doing? You know, how can I help as a banker, and how can I help finance the need and all that? But it is true that the credit score is a factor in that character. And the reason why that is because as a banker, you know, we are looking at your tendencies. Banking is all about risk and risk management, especially the lending side. You know, we are very interested and concerned with, our concern is from the lending side is to, if I lend money out to an individual or a business, you know, am I going to get repaid? And how am I going to get repaid? And how likely is that? There's a bunch of statistics and norms and everything, and this is all the back office people, and a lot of this is public information about, you know, what the general default rates and stuff like that on loans are at, and depending on the type of loan. And it's part of the reason why some banks choose to not work with certain industries, you know, such as like gas stations. Just as an example, gas stations are higher risk. You know, there's an environmental concern because of the gasoline, things like that. Laundromats, also environmental concern, but also it's a cash intensive business, meaning that it's a business that is higher risk for money laundering and things that we as bankers are very sensitive to. These are just examples. So, you know, a lot of the credit score is very much risk-based. And it's also a snapshot, if you will, of the history of your patterns of lending and repayment. You know, if everybody on the call is familiar or has seen your credit score, it is a very black and white representation of, you know, who you borrowed money from, who you actively still have money borrowed to, you know, what your repayment history is if you've been late, and also other information, you know, foreclosures, short sales, collections, things like that. In addition, something else that isn't always talked about is background information, what's called background checks. There are a lot of firms, probably the biggest one is called LexisNexis, and most every bank, including this bank I work for, utilizes. That's also included in what helps us determine character. And if anybody has ever seen, or if you're familiar with what a background check looks like, it looks kind of like a credit bureau, but less in the sense of talking about history of, you know, late payments and stuff like that, but more about, what your public records look like. So your name differences, how you spelled your name differently. If you apply, and this is probably the biggest. This is probably the biggest. Offense is credit cards. Whenever you apply for a credit card, if you're not doing it online and somebody's inputting it, people enter your name sometimes wrong. So unfortunately, when that happens and that information gets entered wrong, sometimes you have a name difference on our credit bureaus or on our background checks. So like I'm actually a junior. My full name is Frank Joseph Maggio Jr., but I sometimes get mistaken as my father because sometimes people forget to put in the junior, is because I'm not senior. But we see all those things, and also things like criminal infractions, speeding tickets and all that. Not that we're making a decision on whether or not to give a loan because of a speeding ticket you got 10 years ago, but we see all those things, and that's part of character. I can tell you that most banks, including ours, do not take this information and make hard line decisions on things like your credit bureau or your background checks. And yes, there are specific examples where those things happen. I'll give you a real-time example. I was at a bank. I was actually underwriting at that point, and we pulled a background check and had somebody that had a very criminal charge dealing with drugs. And we just made a hard decision at that point to say that this is a reason for us not to do a loan to that individual. And yes, that can be very black and white, but it was extreme enough to where we felt that was a good enough reason to do it. And there are other situations though, but when you deal with things like, now, if this was 15 years or so ago, we were just coming out of the big downturn. There were a lot of foreclosures out there. I can tell you that as an underwriter and as a lender, there wasn't a day that went by between, I'd say 2000 and let's see, the downturn started in 7, 8. So it was probably around 9, 10, 11, 12, 13 or so, to where we were on a pretty much an every day or every other day basis dealing with somebody where when you pulled their background or their credit, they had a foreclosure or short sale, something like that, because obviously the real estate industry was affected majorly during that 07, 08 big crash, the Great Recession, I guess we've called it. So, those are situations to where some banks will just say, we will not lend to you. You had a foreclosure, short sale, or a bankruptcy, we will not lend to you. And in some cases, banks that I've worked with, thankfully, we will work with you on a one-on-one basis. It's understanding, and this again goes to character. It's understanding your background. It's understanding why it is that happened. What were the situations? What caused that? How did you get out of it? And every situation is different. And I think you find that with a lot of community banking specifically, you'll find individuals that you can sit down and talk to, explain what happened and explain your story essentially. And if it makes sense to the bank, then we can move on and document it. And because from us, again, we're a risk management based, we're in a very much a risk management based industry. We have to answer to regulators, and those regulators want to make sure that we are kind of dotting the I's and crossing the T's, doing the things that we need to do to make sure that we are addressing all of the issues and risks that we would have to mitigate. Character. So next one, conditions and competition. Whoops, got to go to the next one. So economic environment, health of the market, and it's true, this is the C you have the least control over. Really, this is talking about, what goes on in your industry, whatever your business is, the health of it, things like that. This is just kind of, in some cases, especially with startup businesses or new businesses, this is what we kind of talk about, your barriers to entry. Some companies or some industries have very low barriers to entry. It's easy for you to set up a business. Maybe there's only a little bit of capital, cash, and that's one of the other C's I'll get to. But there's very little capital or cash you have to outlay. Maybe there's not a lot of regulation, not a lot of licensures you have to get. Some industries aren't like that. Some industries you have to get a pile of licensures and all that. That'd be a high barrier to entry type of industry. But those are things we look at and we're very concerned with or looking towards. If you're looking to open a restaurant and we're financing that, how different of a restaurant are you, say, to somebody else that's right next door or just down the street? How are you marketing yourself differently? And those are things that you're putting together in your business plans, which I'm not going to go over, but you probably understand that business plans, especially in startup companies, are very important, especially when it deals with marketing and how you're going to differentiate yourself from competition, or how you're different than, say, anybody else in that industry, depending on what it is. I just happen to pick on restaurants for that example. We'll consider what the money's being used for, and that's kind of your conditions. Lending is very much about what we call sources and uses, matching the purpose for the requested loan. So if you're asking for money to buy real estate, we expect that that money is going to be used to buy that real estate. If you're asking for cash out, and this happens a lot, especially nowadays, especially in Florida, because real estate is expensive, not just to buy, but is also expensive if you own it. And it's worth a lot, so it's lucrative. But if you own $1 million piece of property and you'd like me to lean against it, but you want to use that money to buy another property, well, I'd rather look at that other property that you're buying rather than just the property you want to put money against because you own it free and clear. It's very much, purpose driven. And the same can be said about, the money going into a startup business. So working capital, hiring individuals, your lease payments, things like that, a lot of which can be included in SBA lending, which is primarily used for startup financing, startup businesses itself. The next C I've already I actually haven't mentioned yet, but the next C that's going over is capacity or cash flow. In my banking career, cash flow is kind of what I call it, but capacity is another word that's utilized. Essentially what it's referring to is how you're going to repay us. In pretty much most every case, what a bank looks at when we're looking to do a loan, whatever the loan is, whatever the purpose is, but let's just say for the sake of argument, it's for a startup business or a car wash. I'm just going to pick on car washes now. And so cash flow is obviously customers going and washing their cars and setting up. Now a lot of these car washes have memberships that you can set up for and things like that. And that's the money coming in, and obviously you have to pay your expenses and go about your merry way. Well, what that net income number, and that's what we're interested in. And historically, does the business have cash flow to support the debt that we're looking? If it's a startup business, there is none, so it's projection, and that's what the SBA typically goes by, is projected information. But do those projections make sense? Does the company look like it will generate enough money? Does the industry standard, which is somewhat that prior slide with conditions, does the industry standard dictate that this company should make as much money as you're saying it's going to make, or the conditions that you're putting against it, or not the conditions, but the constraints, the what ifs and the assumptions you're making? Does that align with what the industry says? Car wash typically usually makes between 5 and 15% net operating income off of the gross revenues. You're projecting to make 30%. Something doesn't make sense. But the point is that this C, cash flow, this is what's repaying your loan. This is the first C that as a banker and as a lender that I'm most interested in, because your primary source of repayment for any debt that you take out with the bank is most interested in cash flow. We want to know, how are you using this money, and how are you generating, either using this money, or how is this assisting your business in generating that cash flow, and has it done it historically, or will it do it on an ongoing basis? For most individuals, it's what's called a debt to income, or DTI ratio. So when you're dealing with consumer lending or residential lending, you've probably all heard of, if anybody has bought a house or you've gone through that process, lenders talk about a DTI ratio. And usually they do it on a monthly basis. So usually that's your monthly debt payments. So in this example of a home, it would be your monthly mortgage payment, principal and interest mortgage payment, divided by your monthly income, which in most cases with residential, they use gross income. They don't use net income. And that DTI dictates whether or not you would get a loan or not. And if it's 30%, 20%, you're going to get a loan. If it's 40 or 50 or 60% DTI, it's probably going to be difficult, and you might have to approve. You might be approved for a lower loan amount, or you might have to look for a different house or whatever. On the commercial side, we typically do look at the reverse of it. So I'm just giving you some of the verbiage just so you hear this, because some people on this call may have not heard it. It's what's called a debt coverage ratio or a debt service ratio. They're pretty much used the same from any bank, just interchangeably. It is literally the reverse of that. So what we're looking at is the annual, and we use annual. We typically look at the annual cash flow or net operating or net income of a business, and we're dividing that by the debt payments that company, including the proposed debt that I'm going to be financing for you, to finance. And typical industry standard is about a 1.2 debt coverage ratio. So using easy math, if your business generates $120,000 of annual revenues and your debt payments are $100,000, then that would be a 1.2 debt coverage ratio. The bank will look at that favorably. If it's less than that or it's more than that, obviously situations arise. If it's more than that, that's even better, and we might be able to do something different or better for you. But if it's less than that, we might have to lower the loan amount, look for other factors to offset that. I'm not going to get into those details, but if anybody has a question about it, again, please feel free to throw something in the chat. Again, I just want to remind everybody, if you have any questions or I've said something and you want to clarify, just please shoot something in the chat, and I'd be happy to answer. Let's see. I think that's good on cash flow and capacity. The next one, which I've mentioned, is capital already. Capital is the amount of money you have invested or your down payment invested. Capital is cash, and it's important to a bank because we have to understand, and we want to understand what kind of capacity that you have to weather a storm, and also what the capacity is for you to do what you're looking to do. In real estate, it's the money that you're going to put down in starting up a company. It's obviously the money you're going to put out there to actually start your business or help your business grow or do the things that you need to do for your business. From a residential standpoint, residential lenders typically have kind of a rule of thumb to say 6 months of cash. They usually want to see about 6 months of capital or cash in your reserves, if you will, whether it's a checking, savings, whatever, to kind of pay your regular monthly payments, whether it's the mortgage or other things. In the commercial side, we do exactly the same thing, although we typically don't have an actual rule of thumb. Although the typical rule of thumb for most bankers is about 6 to 12 months. So if you have 6 to 12 months of capital, actual cash saved up to be able to make the payments, if the you-know-what were to hit the fan and you had to draw on some cash, or you have availability to draw on cash, so it could be things like a home equity loan or your credit cards or whatever, then that's considered in a credit decision or a financing decision. So Pablo has asked a question. You should put those equations on the slideshow. I'm in real estate learning myself in the first year. Gotcha. If I had the equations with me, I certainly would, but it's literally very easy. And in fact, if you were able to Google debt to income ratio or debt service coverages, it'll show you those equations, but they're very simple. And in some cases too, there actually are different there are different ways to formulate that equation, and banks will utilize those equations in different ways. I'm not going to go into the full details, but I'm just going to give an example. DTI ratio for like residential consumer, there's actually 2 different ways to calculate that, and there are also 2 different ways to look at it that banks look at both of them. One is called a front end ratio, which is just your monthly P&I payment of your mortgage of the home that you're looking to buy or refinance or whatever it is, divided by your monthly gross income. That's called a front end DTI ratio. And then when you take all of your debts and put them together and put that as the numerator and divide it by your gross your monthly gross income, that's called a back end ratio. And banks look at both of those ratios, and there are standards for both of those. Typically, the front end ratio maximum standard is around 33% or a third. 40 and 45, sometimes some banks will use that, but I would say anywhere between 33 to 40% is a norm. And back end usually is around 40 to 50%. Anything over that, there's usually questions, maybe reasons for the bank to say no. I'm not going to get into those details, but that's typical. And then for what I mentioned before with commercial side, for banking, for what you guys are probably more interested in, which is business lending, the typical norm is the net operating or net income of the business divided by the debt service of all debts, not just the debt that I'm looking to finance for you, whether it's buying a property, equipment purchase, whatever. It's all of your debts, or it's what's called a global. And in that situation, the typical norm or the minimum is a 1.2 ratio. So again, using my math, $120,000 of annual net income divided by $100,000 of debt service would be a 1.2 debt coverage ratio. That's extreme. If your company is not as large, $1,000 or $10,000 or $12,000, excuse me, of annual net income divided by 10,000 would be still a 1.2 ratio. But those things can differ as well. And there are different things we can look at. And I mentioned global debt service coverage. Part of the factors that banks look at from a cash flow situation, which was the slide before this, also includes not just your business. So the business ultimately is really what the bank, from a financing situation, that's really what we're considering, and that's what we're interested in, is that business that we're lending to able to generate the cash flow to be able to produce that debt coverage ratio for us to say we feel comfortable lending you at the business that money. But also at the same time, in addition to that, you as a business owner, or there might be several partners, but let's just for the sake of this argument say that this car wash, the example that I gave, it's owned by one individual. We're also going to be looking at the personal cash flow of that individual and how that globally looks, because the business is one thing, but you as that car wash owner, you might have income from another source, or you might be getting income from that car wash. You might be taking a salary. Well, that salary is going to be deducted from the cash flow of that business. But you as an individual are making salary from that business. But you also might be making other money from another resource or another source. You might be an investor. So you might be a car wash owner, but you also might own a dry cleaning business as well. And you might be getting cash flow from that. So there are other sources that we can also consider too. And those factors are taken into consideration when a bank is looking at financing. And that goes back to that cash flow slide. Capital is pretty, back to this slide though, capital is pretty cut and dry. It's really about cash. The next slide, and I believe this is the last slide if I've done my math correctly, is collateral. And at the end of the day, that's the biggest thing that we are looking at. That's probably the second most important thing that we're looking at after cash flow. Really, it's the purpose of the loan, right? Now, in some cases, collateral is not cut and dry. If it's tangible, if it's something we can put our hands on and something that we can lean against, and it's something physical, for most banks, that's usually more preferred. That's if you are looking to buy a piece of real estate for your business, you've rented a location for 2 or 3 or 4 years and you're big enough, or you've grown and you want to grow even larger, but you also want to own your own place. It's the same argument that an individual would have about renting an apartment and they want to own their own home. It's building equity in something that's tangible that can give you worth, you and your business worth. And in that situation, the collateral is very tangible. It's a piece of real estate. It's an office building. It's a it's a warehouse. It's whatever it is that you're buying and you're operating out of. I can physically touch it. Plus, I can also put a lien against it. And that collateral is important because as a secondary source of repayment, typically what we call the secondary source of repayment after the primary source, which is the cash flow of the business. Typically, a secondary source of repayment in most cases is what's called liquidation of collateral. And that means that in an extreme worst case scenario, if the bank had to collect on the money that you as a business owner cannot repay, the bank would then foreclose out in a situation of a mortgage, but the bank would default a loan. And then in that situation I gave you of a mortgage, we would foreclose out that and then sell that piece of real estate, try to make back the money that we've lent against the property and go about our merry way. Collateral can be very intangible though. And in a lot of business owner situations, or a lot of business situations, especially SBA lending situations, a lot of times there isn't collateral. Say go back to my restaurant example. Say you're a restaurant and you're starting up your business, but you're not going to own the real estate. You're just starting up a restaurant. You found a location, you can lease out of it. You've got a letter of intent to lease a location, and you've got a business plan ready to go, and you're looking for money to start up that business. You've got some money to put into it. That's your capital. You've got projections based on your business plan and based on financials that you've put together with a CPA or advisors that you've worked with. And it looks like the cash flow would be enough to be able to repay the debt that you need to open up the business, and you can put a little money into it. And let's say my SBA lender is going to lend you that money. I don't do SBA loans, but the bank I work with does. And you need to buy some equipment, some kitchen equipment, plus you also need to hire some people. You need to make payments for the first 6 months for the lease, because you need to make those payments because you're not going to initially generate a positive cash flow initially, but after 12 months you are. And we would be financing that. Well, there's really not much for us to take as collateral. We would take what's called a UCC or uniform code for the equipment, which we could have a lien on. But at the end of the day, if the bank ever had to foreclose out or take back equipment, that's not something that's really going to result in a good return. If we're going to sell equipment, a kitchen equipment or plates and things like that for a restaurant, we're not going to make back most of our money. And in some cases with the SBA, for those of you that might have some experience with, or if anybody has ever talked about SBA or delved into SBA, very frequently the SBA will take second mortgages on a home if there's equity there. And that is a way for them to mitigate some of that risk, because if you do own your own home and there's say $100,000 of equity in it, and you're doing a loan for $150,000 to the SBA for a startup of your restaurant, at least they know that there's some equity they could potentially go after in an extreme recourse scenario. But that's collateral. Collateral is securing, and typically the collateral being taken is going to match the purpose of the loan. But in some cases, like the example I just gave with SBA, if there's not enough, and there's an uncomfort level and there's a risk mitigation needed, they might go after something else. And in some cases, it can also be other intangible things. For a lot of business loans with SBA, SBA may require what's called key man life insurance. If you're the sole business owner and you were to pass away, if you have what's called key man life insurance, that policy would kick in and potentially repay whatever debt was out there, because as the sole owner and the sole individual that really runs that business, you're the key individual, and that's what insurance like that is for, and could potentially repay the debt that the bank may hand out. There are other alternative collateral sources or other sources of collateral. I used in my career anything upwards of anything including CDs, certificates of deposit, marketable securities, anything that's publicly traded, which is basically convertible, pretty readily convertible to cash, real estate, other real estate that has nothing to do with what you're lending against. Maybe sometimes that property is generating cash flow that could support the debt, but the property that we're lending against directly may not have that cash flow now. There are a bunch of different ways you can collateralize, and also non-tangible things like I mentioned, things like life insurance, equipment, which you can technically lend. Oops, excuse me, I had a phone call coming through, which you can lend to, but can be very difficult to collect from. But that's collateral. So Karen said everything. Okay, I appreciate that feedback, Karen. Thank you. So what I'm going to get into specifically, which is more about financial literacy, is about credit bureaus. Let me stop real quick again. Anybody else have any questions, or does anybody have anything you want me to clarify before I move on?
Yeah, please type it into Q&A or chat, either one. Frank's watching them both. And I thought the comment on the coverage ratios, being a career banker, Frank, as you and I were talking, was a really good one. Just that, what ratios do banks look at? And I'll just throw out that Score Mentors can explain that to you as well, because there are many. There are basic ones Frank was mentioning, but again, another reason you can request a Score Mentor.
Mm-hmm. These are the credit bureaus that are out there. I think most everybody's probably familiar with them, but I'm just putting them here just so everybody's aware of. Experian, Transient. Typically, most banks, especially commercial banks, will use one of the three. Pretty much industry standard, usually Experian. That's why it's on the top of the list. That's who we use here at BayFirst. I've actually used all three in my banking career, particularly on the residential side, though. I'll just point that out. They use what's called a tri-merge report, which is actually all three of these credit bureaus merged into one report, and they get all three scores from each of them. And yes, the scores differ in all three. And the reason why is because each credit bureau uses a slightly different model and scoring factors that go into that score. But all things being equal, the scores usually are anywhere between, I'd say, 50 to 75 points difference between the two. It's not uncommon for me to see a score of, say, 800 from one and maybe 725 on another. It just depends on the information that they're kind of using to then make that score. I'm not going to get into the details of that. That could be a whole another conversation, but those are the credit bureaus that all banks are working with typically. Commercially, though, we're usually just using the one credit bureau. Parts of your credit report, I'm not going to go through this really, but just so you understand from a financial literacy standpoint, I mentioned it earlier. Your credit bureau, your credit bureau really does have a lot of information on it. Personal information, has your social security number, has your addresses, it has prior addresses, not all of them, but usually about one or two. Your employer, prior employers, again, not all of them, but say one or two. But more particularly, what we're looking at on the banking side is the information just after all the personal information, and it really digs into then what are your payment history, what is your payment history like, 30, 60, 90-day lates, collections, and then it actually specifically details out. So-and-so, Mr. Smith has a loan with American Honda Finance. I just picked on that because I have a Honda. We can see when it originated 2 years ago, and we can see the payment history, current every single month. Oh, no, he was late 1 month. And that could give me a reason to ask Mr. Smith the question, hey, why were you late this 1 month? I forgot, I was on vacation. My wife didn't make the payment. Sorry, I didn't mean to pick on his wife. My accountant forgot to do it because I gave him all the control to do everything, whatever the reason is. But it gives me an opportunity to have questions. I start seeing credit bureaus that have 15, 20 day, or 15 or 20, 30, 60, 90-day lates on 5 or 6 or 7 different trade accounts, credit card, auto loan, mortgages, all that. That's a big red flag, and I'm going to have a further conversation. But that's the point is just so you understand that it does include a lot of information. One thing I will point out, which
Frank, we got two questions real quick. I know you want to be interrupted.
No, go ahead.
Credit companies for businesses as well.
Yeah, there are. So different than Experian, Equifax, TransUnion, it's Better Business Bureau. And there are a couple industry ones that do provide a business credit score. It is a different type of number, or it is a different number altogether than you see on a personal credit score. But there is such a thing, and typically it's less the number and it's more the risk rating or weighting, excuse me, that goes into that model. But it does produce very similar information that like a personal credit bureau is. If your business has enough information that Better Business Bureau and things like that can collect, it will have information that includes anytime your business has liened something and it has had a UCC filed against it or a mortgage filed against it, or what your public records filing is dated of, or has it been updated recently, and you're supposed to file annual reports for your business with your corporate business, your state's corporate business side, filing annual reports and make sure you're still active, or if your business is licensed and things like that. It also includes, if you have vendors that are more public in the sense of, they provide that information to an agency, so that, we as a bank know that if you are paying on your, net 30 or 45-day terms, how quickly do you make those payments? Are you late on those things? That is information that's collected. But again, like credit bureaus, it is a very much a garbage in, garbage out situation. Not all the time does all the information adequately or accurately get presented to those agencies, just like your personal credit bureau. And then sometimes that might give me, the bank, garbage. And what I was going to bring up is that you as the business owner, or you as an individual are, and this is something that isn't always discussed, so I want to make sure to mention it today, because of the FACT Act or FACTA Act. This is personal though. On your personal credit bureaus, if there is anything that's incorrect on those things, it is your responsibility, or excuse me, it is your right, but it is the bank's responsibility in pulling that credit bureau to inform you if we found something that is derogatory, and it is your right as the individual to let us know, hey, that's incorrect, and you have the right to be able to then go to that credit bureau and provide them the information to show that this is incorrect and it needs to be corrected. Because very much so, the information that the bank is obtaining from the credit bureau can influence our decision. Now, back to my earlier comment, we look at everything. We scrutinize it and we ask questions. We're not, in most cases, we're not usually just taking a very hard line, pulling a bureau and saying there's this on it, and we just immediately say no. We typically will have a conversation. Again, all things being equal. There's some extreme examples, but all things being equal, we're going to want to have a conversation. And that's where community banking can be very collaboratory, in the sense of having a conversation with the borrower, the individual, the business owner, to say, hey, I noticed a few things on your credit bureau. Let's talk about it real quick. I don't need a lot of detail, but I just need to understand what happened. And in some cases, that's a very easy way for the bank to find out that there's something wrong, because not just because you've done something wrong, but because something was reported wrong. So we want to make sure that you, and as a business owner and as an individual, I want to make sure you understand that there are ways to fix those things if it's incorrect. You said there was another question, Doug?
Yeah, Frank, we have two more questions on the Q&A. The first one is, what's the difference between hard versus soft inquiry?
Yeah, that's a good question. So typically soft inquiries are only pulled, most often not, those are pulled usually on residential loans for like pre-approval. So like if you're trying to get pre-approved for a loan, the reason for a soft pull is that what you're doing is so it doesn't fully ding your credit, and it's not actually, and when I say ding, meaning affecting your score, a soft pull doesn't give us the score. It just gives us the information that's going to be calculated into the score. Because once a bank pulls a hard pull, it actually then goes on your history. And guess what? If you didn't know this, you know this now. Hard pulls, when a finance institution, whether it's a bank or any other institution, a mortgage brokerage or anything that has access to credit bureaus, when they make a hard pull, that does ding your credit and can affect your score. And that's actually, by the way, one of the differences between, say, two of the credit bureaus. One of them will actually look at, so let's just pretend, for the sake of argument, you go out to Honda. I'll pick on Honda again because I own a Honda. Let's say I'm going to go car shopping and I go to all the major car manufacturers, Honda, GM, whatever all the other ones are, and I decide to test drive cars at every single one of them. Every single time you go to an auto place, a dealer, and you give them your driver's license, they're doing two things. They're going to make a copy of it, and they're going to pull your credit bureau. And they're going to do it before the salesperson even gets you into a car, because that way the salesperson already knows what your credit score is. And, are you going to be somebody that's likely going to buy a car today? But when they do that, they're pulling your credit, which is a hard pull, meaning they get the score and they get your history because they want to know who they're dealing with. They want to know if you're likely to buy a vehicle that day or very soon. And if you go and do that at, say, 3 or 4 or 5 other locations that same day or within 24, 48 hours, one of the credit bureaus will ding your credit every single time. One of the credit bureaus actually takes that and combines it because they understand that you're, say, shopping for a vehicle. This is a very normal, thing that people can do in looking for and buying a vehicle and financing it. A soft pull doesn't include the credit score, but does include the background history. You have 30, 60-day lates, you have perfect credit, whatever the situation is. But a hard pull does give the full history, all of the information, and does produce a credit score. So that is the difference.
That's great information to have. I don't think many people know that. Here's a good one for you, Frank. My business bank advises that I should have and use their branded Visa MasterCard as it weighs more on getting credit lines, loans with them. How accurate is this? As I know bank employees get incentives for attaining new credit card customers.
That's 100% dead on, exactly. And I would point out that as a business individual, even as an individual, you should never feel pressured just to take out whatever product that one bank or financial institution has over another. Do your own research, ask your questions. Yes, there typically are incentives. I'm a lender. I'm a production side individual. I work with a business and I'm going to make a loan to them, but I also see that they have a residential mortgage. I'm going to ask them the question, what's your interest rate at? Hey, your interest rate is at that. I know that right now interest rates are lower than that. I'd be happy to introduce you to my residential lender and to refinance that mortgage. That way that could improve your cash flow and have you pay less in interest payments over time. Yes, I'm going to get incented on that, but I'm also looking out for the best interest of the customer. Make sure that whatever banker or lender or whoever it is you're working with, you're asking questions like that to make sure that they're doing something that's in your best interests. If that credit card truly is a good thing for you to have as a business and will help you, then yes, by all means, go ahead and enter into that. But if the individual is just trying to sell you something, I think we all have experienced salesmen. I hate to pick on car salesmen, but that's the typical one that everybody always thinks about, I think. But don't be fooled into or lulled into that car salesman type mentality of, I need it, I have to have it. Don't have FOMO, don't have the fear of missing out. Ask questions, think about something before making a decision on that, and make sure that it's really in your company's best interest. Part of this goes back to my earlier comment about taking time and actually sitting down and talking with a banker about what your needs are. Because in some cases, I can tell you that in sitting down and talking with a customer, what they want isn't and how they want to get it isn't necessarily always the answer. Because I might be able to help them and advise them into how to get what they want, but look at alternative ways to do that. Now, I don't know the specific situation, but the example that Doug gave from or mentioned through this other individual that mentioned it or that asked the question, maybe there's a reason why that bank is asking for that, but based on just what it was said, it just sounds like a sales mentality. It sounds like just basically, here, sign up for this. It's good for you. It'll help me. It'll help me sell your loan that your bigger situation you're going to get. But there might be reasons why they're saying that. And so I don't know the full situation, but in some circumstances for a business, I do a real estate loan, and let's say it's a seasonal type business that makes something, so like say a manufacturing type company, I might advise them to do a line of credit to help with their seasonal needs, because as seasonality happens, they may get a rush order and need to buy a bunch of inventory, but might not have a lot of cash on hand. Well, they could draw on a line of credit to be able to pay for that inventory they need to purchase to be able to sell that good to manufacture. And then once they get that cash flow coming in, that receivable coming in, then they can pay that line of credit down. And that can help them either grow or continue as a business. And that's a possible solution. I don't know if that's the situation, but it just is an example. But again, in my opinion, it all comes down to just sitting down and having a conversation and figuring out, is this best for your business?
Any other questions? We've got some time left with Frank. I think it's been very informative. Chat or Q&A, if you've got another question.
I'm just really quick going through. If anybody else has a question, please ask. But I'm just going through the slides. I like to have conversations more than go and talk directly from slides. So all of these slides are talking about budgeting. Where's my money? The importance of building and some of this goes to in a business plan. sitting down and figuring out where the cash is coming from, what you have to pay. It's no different on the individual side. Where am I making my money from? How is it coming in, or how much is it? And what do I need to pay out on a monthly basis? It's how we talk about budgeting as an individual. It applies the same to businesses. Understanding where your cash is coming in, how much it is, what needs to be paid, what doesn't have to be paid, and is a luxury, and what you could potentially cut. Doing those basic things can help you not only as a business, but as an individual as well too. Talking about financial checkups, what I just mentioned, going through where the money's coming to, where the money is coming from, and where it's going to. Doing a checkup regularly. I advise anybody who's, whether in your 30s, 20s, 30s, coming out of college, even 40s, 50s, older. When you get older, you start dealing with retirement, and if you're not working anymore, and it's the same thing. It's looking at what money's coming in and what you have to pay. Couple of questions. Do you also help with construct? We do construction loans, and I think by and large you'll find most banks do construction loans. The biggest problem right now, and I'll just offer this up, with construction right now is just because of what's happened in the industry and the economy in general. Over the last year to year and a half, almost 2 years now, construction costs have gone up. So most banks are a little more sensitive right now to construction, just because we want to make sure that construction cost increases have been accounted for, making sure there's capacity, or capital, cash on reserves to help with any potential cost increases. But yes, we do construction loans. I've actually done a lot of infill residential construction lending in the Newtown community, just as an example. These are individuals that own lots that are doing infill constructions. Most of it actually is lending out through Section 8, which is rent controlled, but have done constructions for businesses, operating businesses, things like that, renovations to businesses and whatnot. We have a lot that we want to build a house on. We're going to rent out. So yeah, so I could help with that, Joy. If you want to rent it or sell it, that's an investment situation. Depending on the bank you're working with, typically they're going to send it to a commercial lender as opposed to residential, but there are residential resources to handle that as well. But yes, that is something that I could look at. I will mention though that BayFirst, from a conventional standpoint, we're a Tampa Bay market bank, which means that our lending area is basically the Tampa market. So for those of you that are in Florida, or the Southwest Florida area, it's basically Southwest Florida. So it's basically Tampa and some of the counties just above that, all the way down to basically Collier County. But our primary market area is Hillsborough, which is Tampa, St. Pete, which is Pinellas County, Manatee, which is Bradenton and Lakewood Ranch, and Sarasota, which is Sarasota, Venice, Northport. That's our kind of primary market area. Ryan, thank you very much for the comment. Oh, wow. Yes, Ryan McCarthy, I do know you. That's great. It's good to see you as well. Melinda, you're very welcome. If anybody else has any questions, please feel free to ask. I apologize I didn't get a chance to go through all of the slides, but part of this, the rest of this is about making a budget, which is really going into a lot of financial planning and business planning, the importance in doing that. So the rest of the slide really just talks about that, or the rest of the presentation really talks about that. It'll all be available to everybody, as Doug mentioned, and I appreciate everybody's time. So my contact information is on the slides, and anybody has any questions, please feel free to email me or call me. Again, just be aware I'll be out on vacation until June 12th.
So thanks. Thank you, Frank. Great job. We want to mention again, visit score.org/Minnesota to request a mentor or to see upcoming webinars. You will get a copy of this sent to you, recorded, and also the PDF. There'll be a survey coming. How can we improve? What other topics are you interested in? I think Frank deserved a 10 today. Myself, he did a great job. So please fill that out when you get that. And are there any other questions that anyone has? All right. With that, we will conclude today's Zoom presentation. Thanks, everybody. Thanks, Frank. Great job.
Thank you.